Hey all, we're here to talk about Everpure. Do you know what that is?
FKA Pure Storage. It's still orange. Logo stays the same. What do you think about the name, though?
I hate it.
Why do you hate it?
It sounds like a water company, like bottled water, Everpure, Ever
Yeah.
Distilled.
I thought it sounded like a wellness spa, but then after thinking about it a little bit more, I actually thought of Tom Haverford on Parks and Rec, and it totally sounds like a brand that he would have come up with.
Like Tommy Fresh.
Exactly.
All jokes aside, we're going to talk about Everpure, their ongoing shift in business model, and take a look at why maybe the market is not so excited about this company.
Yeah, on the surface, it would seem like there's a lack of excitement about the accelerating revenue growth, which was not a surprise to all of you here at Chipstock Investor, but maybe a little bit more nuanced than just a lack of surprise. Probably the market just trying to figure out that shifting business model and what it means for the ever important future cash flow for the business.
Let's take a quick look at where Everpure fits in the semiconductor supply chain using our supply chain analysis tool on chipstockinvestor.com. We would put Everpure in the tech equipment and devices part of the industry. Upstream integrated device manufacturers, especially memory makers like Kioxia, Micron, SK Hynix, and Samsung. And Everpure's customers, especially the biggest customer, would be a company like Meta, a hyperscaler.
Yeah, that was revealed now over a year ago that was the big data center operator that Everpure was in discussions with. And it looks like we are now getting the initial results of that. And here's the curveball. You just said we actually have Everpure listed as a tech equipment and devices company, but there has obviously always been, for especially the last 5 years since the acquisition of Portworks, a very large software layer and software component of this business. And this is where the name change comes in, as well as the acquisition of OneTouch, which we'll get into here for just a minute. The company is basically no longer just trying to pioneer NAND flash-based storage, semiconductor-based storage arrays, but data management software overall. It's a data management company.
Here's a quote from the CEO regarding this ongoing shift to provide more than just hardware services. Evergreen is their storage as a service platform, and Purity has been their data control software system. And they're making this shift into more enterprise companies. In fact, they said that they can now service any kind of enterprise data customer.
And this is where Everpure, super weird saying that, Everpure Fusion comes into play, created by that acquisition of Portworks a number of years ago. And now this addition of OneTouch, or what they're going to now call Pure One, which they're going to use to help customers be able to unify their data. Particularly important when you think about AI agents running around a customer's cloud operations or running around their private data center operations, running around the internet, gathering up, accessing different sources of data to make decisions. There could be a lot of governance and control issues with that. And so this acquisition of the startup OneTouch will get added to the software platform and help companies be able to find, mark, and govern who or what doesn't have access to the data. And so all of this is going to fall into the broader product category called DSPM, Data Security Posture Management, which, if you're part of Semi Insider, we're going to talk about that this week on our live event with the cybersecurity refresh. A lot has happened in data security in the last couple of years. And so it seems like Everpure is now setting itself up to participate, at least in part, in that market as well. For us, I think it's a natural fit. They've already had the software layer to the platform all along. And so this is a natural extension, which especially makes sense as we start to talk about AI data centers and the stress that is putting on the memory supply chain. Now, Casey, let me tee this up for you, because in tandem with all of this, the migration to more of a software company, lots of R&D being poured into software, not just the development of direct flash-based memory arrays. They talked about the R&D expenses now higher than any of its competitors, specifically when targeting this next-gen memory technology. We've got a snapshot here from the Chipstock Investor web app comparing R&D expense for Everpure versus, let's say, their closest pure-play competitor, NetApp.
Yes, this has been quite the discussion, especially on the last quarter's earnings call, as well as this most recent earnings call about their R&D expense. They're ramping that up significantly. And on the left, you can see that Everpure's R&D spend in the last year almost reaching $1 billion. And as Nick said, one of the closest competitors, NetApp, just a skosh under $1 billion as well. But we fully expect that R&D expense for Everpure is going to actually go higher than NetApp. And as pretty much everyone is aware, there has been a little thing called memory shortage in the recent year. That means that the demand for memory is outstripping the supply for memory, and that is increasing the cost of memory products, memory components significantly. Everpure just announced that they did price increase across the board for all of their products February 9th, 2026. They're one of the last of their competitors to increase prices for all of these components, all of this hardware, despite the fact that the component pricing has gone ballistic. Of course, with that price increase, we're probably not going to see anything reflected in Q1 of 2026, but most likely we'll start to see those price increases reflected in Q2 of 2026. Back to the gross margins. That's definitely something that we need to take a closer look at.
Yeah, and if you've been here with us for a while now, we've been covering Everpure for a couple of years, and we discussed this at length over a year ago when the deal with Meta was first unveiled. There is ongoing transformation of the business model because essentially what is happening is Meta is going to purchase the memory directly from the supplier. In this case, for NAND flash, it's going to be Kioxia. But because of that memory shortage, Meta isn't just going to be purchasing strictly NAND flash. They are also going to want high capacity HDDs, hard disk drives. And this kind of makes sense why business model is shifting even further towards software as well as IP licensing of technology. Everpure is becoming essentially a type of engineer. They're helping Meta engineer this next-gen high-performance storage array. Meta can choose whatever actual hardware it wants for that data storage. Everpure is going to help them build it, license them software to help manage it, create a unified look of the data, observability, management, identity, all of that stuff for the data. And as a result, investors had expected that not only would revenue growth accelerate this year, but there was also going to be an acceleration in overall profitability. And that is still the expectation, but these are probably growing pains that we're looking at right here. There is a bit of delay because of the offset of the higher component pricing and part of the business, and that is going to be essentially offset by the higher margin of the IP licensing and software sale to Meta and potentially down the road other hyperscaler customers as well. So the expectation historically, Everpure 65 to 70% gross margin. The expectation was it was going to be much higher than that starting this year, but that is just going to simply take some time for that higher 75 to 85% gross margin from the Meta deal to trickle down into the actual financial results.
Let's run down what the guidance is for fiscal year 2027, mostly corresponds to calendar year 2026. Revenue, 4.3 to 4.4 billion, which would equate to year-over-year growth of 17 to 20%.
So therein lies one problem. The Q1 guidance was for 28% year-over-year revenue growth. So the full year guidance actually forecasts a significant deceleration in revenue as the year progresses. Still higher than last year, but nevertheless, at least as far as the numbers imply right now, Q1 of this new fiscal year, which ends in April, a couple of months, is going to be peak revenue growth for this particular deal surrounding Meta and Everpure.
I will say that Everpure management does have a tendency to sandbag a little bit. We still expect the second half of 2026, based on what management said, to be quite good. But we'll just have to see what those numbers shake out to be.
Here's a look at the historical revenue. You can see in orange subscription. That is the evergreen storage as a service, but increasingly over time, that is also including a lot of software bundled with the hardware sales as well. Over the next year or two, especially, we would expect that percentage to expand quite a bit. And as a result of all these moving parts and pieces, the name change reflecting them being more of a data management and software company, the higher cost of components affecting the hardware sales, and the effects of this build out with Meta and perhaps not too far down the road, maybe another hyperscaler customer or two, is sending the investing community for a bit of a loop as they try to forecast what the cash flows are going to be. So gross profit margin at the exit of the last fiscal year in January was at 70%. Not bad within the historical norm. GAAP operating margins were up to 8%. Free cash flow has been pretty decent, not overall growing, but decent. Bear in mind that there was a cyclical downturn in the memory market over the last couple of years, including for NAND flash system builders. So the market previously had been forecasting this free cash flow number to make a significant jump in Q1, $263 million. And in both the earnings call and two investor events that followed hot on the heels of the last earnings update, analysts asked several dozen times about margins, how margins are going to be affected this year. And the short answer is we're just going to have to wait and see. There was no real solid guidance on this, just a lot of moving parts. And so what does this mean for investor returns and for modeling the future trajectory of PSTG, Everpure stock? We are expecting here at least another couple of quarters of overall flat-ish free cash flow per share performance.
As you know, we are happy shareholders of Everpure, formerly known as Pure Storage. Thankfully, the ticker stays the same, PSTG. But this is a small bet, a wait and see. We're happy with what we have right now, but certainly something we're going to continue to monitor. If you're willing to see a little bit of volatility, maybe this is an interesting pick for your portfolio. But we'll keep you updated. And we'll have a full discussion. We have more slides, more information over on Semi Insider, which you can check out at chipstockinvestor.com. We'd love to see you over there. And until April 15th, you can get access to our Discord server. After that, we're actually closing the Discord server to new members. So make sure you check it out now. We'll see you over there. And if you're super interested in the memory market, make sure you check out this video we did on SanDisk.
Casey told you all back in October, SanDisk was cool again. Check out the latest update.
Boy, is it ever.